so this meeting is being recorded. Hopefully you all are okay with that. I know we have a few people who could not make it today, but wanted to hear the information, so we'll share it with them after the fact. But I'm really, I'm going to say continue. I'm fine with it being recorded. I am excited to welcome you all to our virtual event of Securing the Future of Healthcare in Northern New York. It is a partnership program with our New York affiliates of Hyde Medical Center, Elizabethtown Community Hospital, and the foundation of CVPH. My name is Carrie Haley, as you can see on the screen, and I'm the Associate Vice President of Philanthropy for the foundation of CVPH. And I'm also joined by my colleagues. Here we have Chantel Marshall, who is our Director of Philanthropy for Hyde. And we have Elizabeth Rogers, who is our Director of Communications and Engagement Strategies for Elizabethtown Community Hospital. And we also have Drew, who's up in my corner, and he is doing all of our Zoom technology today. So shout out to Drew for helping with all of that. It's nice to not have to worry about those things. So just to start off, I want to say that I speak for Chantel, Elizabeth, and myself in expressing our gratitude that we have for the support that you have given to our local hospitals. And for some of you, it's been for many years. Your commitment to investing in healthcare has elevated the work that we do and that we provide to our local residents every day. And this past year in particular, your support has helped us weather through a global pandemic. I mean, a healthcare crisis that we have never seen before, and hopefully we will never see again. It's really, truly heartfelt support that has come through this time, and it's meant more than you might even have realized, because it's not just the financial support, it's been the emotional support through all of this too. Each of our organizations now is looking very forward to some normalcy as we're bringing back our services, looking forward to new projects and programs that we're going to be putting together for our local communities. So if you don't know, certainly I encourage you to reach out to Chantel, Elizabeth, or myself to learn more about some of the projects that are happening at our local hospitals. Throughout our time, we are often asked questions about how else you can help with supporting the hospital, what other types of gifts you can make. So with our panel of experts we have today, we hope to leave you with a few new ideas that will impact healthcare for the organization that's closest to your heart. Whether that's establishing a legacy gift or that's identifying a new method of giving, anything we can help with is we're happy to do. And what's great is that there are some cool ways that you can give a gift that actually has a financial advantage to you as a donor as well. So you get not only that warm feeling of giving to something that is meaningful to you, but it also is helping you in the long run too. So to open our discussion today, we actually have Ellie Berger here with us, who is a respected community member. And she's just going to share briefly about a type of gift that she has set up and why she is doing that.
Can you hear me? Am I coming across? Good. When Carrie asked me to do this, of course, I immediately said yes, because that's what one says to Carrie. And then I hung up the phone and I thought, oh my goodness, what am I going to say about my private decision making? But I thought I would share it and tell you what I'm planning to do and why I'm planning to do it. Legacy decisions for me are about gratitude and my hopes for the future. I think of giving as sharing the goodness that I have had the privilege to enjoy. I know that is a common feeling and it's a good feeling. Much of my life's volunteer work has been in conservation, mostly focused on keeping Lake Champlain healthy. So it has been a logical choice for me to name in my estate plans the foundation, which is an organization dedicated to supporting the health of an entire community, along with the hospital upon which that community depends. I've been a part of the CVPH family working as a pet therapy volunteer and as the community representative on the Integrative Medicine Committee. So I am delighted that I can further my commitment to integrative medicine by directing my legacy to help that specialty expand right here in the future. And I'd like to just close with some thoughts that are, I'm sure, just obvious to everyone here. And that is that there is something so rewarding and comforting and joyful for us whenever we are able to do something good, which I feel I can continue to do with a legacy gift to the foundation, and through the foundation to our hospital, which we all depend upon, and to our wonderful community. So thank you very much. I look forward to hearing what everyone is going to say today. Take care.
Thank you very much, Ellie, for sharing that. I really appreciate it and appreciate you being here today. So we are very thankful also to have our panel with us and giving their time today to share their expertise with all of you. So I'll introduce them now. We have Nick Eels, who's a CPA and CGMA. He's a managing partner for the Hoffman Eels Group. We have Bradley Fletcher, who's a JD, Senior Planned Giving Officer for UVM Health Network. And we have Christina Ubel, CFP, and a partner at Clue Wealth Management. So our panelists have a few talking points that they're going to share when, and then we're going to open it up to questions. And I have a few questions that have been sent in ahead of time too, so we can use those to get us rolling. But this session really is for all of you, so please ask any question that comes to mind, and our group will be happy to answer it in the best way that they can. And to do that, you can literally wave your hand and we can watch for that and open the mic for you, or you can type it into the chat and we can read it out for you either way that you would like. And with that, your time is also very important to us. So we are going to stick to the 60-minute window that we've allotted for today. But if someone has questions when the session is done, our panelists have all agreed to stay on a few extra minutes too. So know that we have that. So I will turn this over now to Nick and Bradley and Christina.
Thank you, Carrie. Yes, and please keep track of your questions. We are hoping to answer your questions, and that's part of the reason we've kind of gathered our panel of experts, though I feel kind of weird calling myself that, but that's what we're here for. We want to answer some questions that you might have about philanthropy for us after our talking points. And thank you, Ellie, for sharing your perspective and story. So I've been doing planned giving for a few years, and one of my favorite things about it is that before COVID, I used to travel around the country and meet lots of legacy givers for different institutions and hear their stories about why they care so much about a charity that they include the charity in their legacy documents, which, if you think about it, is like adding a family member, because those are the other people in your legacy documents. And so it's a big deal. And I always appreciate when people are willing to share with their charities that they're making plans, because one of my other favorite things about planned giving is the opportunity to have those conversations and to get to know the donors who are making that commitment. And it's really wonderful to be able to thank them. You may not know this if you're not in philanthropy as a fundraiser, but most legacy gifts come into institutions kind of unknown or anonymously. People will put you in their legacy documents and they don't reach out to let you know that, and you still get the gift, but you never get a chance to thank these people. And that's actually most of our gifts. So that's part of the reason we're always asking people to come forward, is because we want to have a chance to thank them for what they're doing. And the other thing I love about planned giving is it's an opportunity to consider gifts that have some unusual advantages for donors. You know, most people, including myself, when I think of charities I give to, I think, let's get the checkbook and write a check, or the Venmo, I guess now. But there's a lot of different ways that you can give other than that, and some of them have advantages for the donors, and advantages for the institutions. And the best thing is they provide a chance to make a huge impact for people who don't always think of themselves as people who can make a big impact at a charity. You know, I couldn't write you a $50,000 check this year, or probably not 10 years from now, but I can leave you a percentage of my legacy to an institution, and it might be worth that or more by the time I get there, if I get to live out my life expectancy. So, and those kind of gifts make a huge difference, and they're the backbone of hospitals' expansion and growing and replacing equipment and things that go above and beyond the sort of expenses of just providing care. So they're hugely important. So wills and trust and legacy gifts are, what I'm trying to say is, they're sort of the backbone of keeping an institution like CVPH in Elizabethtown and Hyde thriving and growing, and not just being adequate, but excelling. And we want to thank anyone who's considered or has made that commitment and gift. So we're always asking people to come forward. But let's talk about the more interesting gifts. There are a few things in plan giving that we just want to make sure everyone knows about because of those advantages and opportunities that I was talking about. One thing is the CARES Act that provided some of the economic relief and a variety of changes to tax law and all kinds of things. Well, they actually embedded a couple of charitable gift incentives into the CARES Act for 2021. I'm going to ask Nick to talk about these a little bit with his tax accounting background. But one thing is the $300 per person tax credit, which works a little differently than the usual charitable deductions. And they have raised the limit on charitable deductions related to your income. So I'm going to kick it over to Nick and ask him to sort of explain that a little bit for us and how that might benefit you as a donor.
Thanks, Bradley. Hey everybody, I'm Nick. Thanks for asking me to join. So the CARES Act, just real brief. The CARES Act was passed in March of 2020 as a relief package for the pandemic. There's a number of stimulus packages involved with that, and it was designed to help individuals and businesses get through the challenging times. Also in that, as Bradley mentioned, there was some new tax language on charitable contributions. Prior to the CARES Act, if you didn't itemize on your individual tax return and you made charitable contributions, you may not have received any tax benefit for those charitable contributions. So in 2020, there was a $300 above the line. Essentially, everybody who makes charitable contributions received a $300 charitable deduction. That was extended to 2021. In addition, they implemented a $600 charitable above the line deduction for married couples. The above the line charitable contribution deduction doesn't apply to carryovers or anything like that. And it does have to be a cash contribution. It can't be a contribution of something other than cash. One of the other things that was part of the CARES Act is they temporarily, so for 2020 and 2021, they suspended the 60% limitation for cash contributions. So prior to CARES, if you made a charitable contribution and you itemized, you could only reduce your taxable adjusted gross income down to 60%. You were limited. Any contributions above that carried forward. So for 2020 and 2021, that 60% limitation has been removed, and charitable contributions can reduce your income all the way down to zero. So that's so there's no limitation. So that's a nice planning tool, an opportunity to maximize tax savings in 2021. If by chance you do make a contribution and it exceeds your taxable income, it does carry forward and can be used in subsequent years. You can carry that forward for 5 years. Also, if corporations, businesses, they also can make charitable contributions. The rules are a little different for corporations. But as part of the CARES Act, corporations can use charitable contributions up to 25% of their taxable income. That increased from 10% prior to the CARES. That also expires at the end of 2021.
Awesome. Thanks, Nick. So those were actually mostly about cash gifts. But I promise we're going to talk about some planned giving non-cash gifts as well. So I'm going to hand it over to Christina in just a second to tell us a little bit about highly appreciated asset gifts, which, as I say, most donors, we reach for our checkbook and we write a check, but you might be missing out on some significant tax advantages if you have some stocks or other things around. So Christina, if you would tell us a little bit more about that, please.
Sure, no problem. Hi, everybody. I'm Christina, as they mentioned, and I'm a certified financial planner at Clue Wealth Management, co-owner. And we often work with our clients to try to look at ways other than just writing a typical check, like Bradley was talking about, out of their checkbook. And so one of the more interesting ways to gift is possibly looking at after-tax investments or non-qualified, people use different names, and seeing if somebody has something in there that has a significant gain on it, but that they might not necessarily want to sell because they would have to pay taxes on that gain, capital gains taxes. And so we talk to them, we ask everybody actually if they're charitably inclined. So, and if they say yes, then that starts the conversation of how we start to look at things in a different light. So if we find that they do have this asset, say they've gained $10,000 or more on it, we ask them what community foundations they support or what charitable organizations. And then we talk to that organization and ask them if they have the ability to accept assets in kind, which means that it wouldn't have to be sold. It could just be transferred directly to CVPH or anybody in the UVM network. And so they could hold it. So it could be a stock, and that's normally what it would be. So that it doesn't have to be sold, and it doesn't have to be the whole position either. It could be a portion. I know somebody that does a specified dollar amount per year, and they just see what the share value is. So they just transfer those shares every single year. It's not the same amount. It really depends on the fluctuating stock price, but they have a position that they love to hold. They don't want to sell it, but they still want to be able to give. And so this is just a great, easy way in order to do that. In the past, we've seen people gift houses because they didn't want to sell a second home and have to pay taxes on the second home. There's a lot of different ways out there that you can get creative in not only saving yourself on taxes and possibly getting a tax deduction, but that's Nick's area of expertise, but also in order to give the organization maybe something that could appreciate from where you gave it to them. You know, they might be able to hold on to it, and it might be worth $10,000 today or $1 today. And, you know, they could hold it till it grows to, you know, whatever number they're looking at. So it gives them real potential for a higher return on something that's gifted to them. So lots of benefits to looking at highly appreciated assets. Again, not just stocks. It could be the house. It could be property somewhere. So really looking at your entire portfolio and seeing what it is that you could have access to.
Thank you. Yeah, I've seen gifts of ski boats, condos in the Watergate Hotel.
Okay, I've never heard of those.
There's all kinds of valuable assets out there that people start looking around and maybe they don't really need anymore. But I just wanted to clarify, Christina, if my understanding is correct about this, but if a person bought a stock for, say, $10 and it was worth $100, they would in effect be giving a $100 gift to the hospital, right? And not paying taxes on the $90 of growth.
Yeah. Well, and again, there are some, like Nick was saying, right now, the 60% cap on contributions to income, that's kind of eliminated, but I don't want to give tax advice there, but yeah.
Fair enough. Yeah. Fair enough. Okay. And one other important thing that I want to make sure we cover is gifts from IRAs, because so many people have IRAs now. They're obviously the most common form of retirement investing now that pensions are sort of gone by the wayside. And there's a lot of nuances to IRAs. One thing I like to talk about in planned giving is that when you are setting your beneficiaries of your IRA accounts, you can do them by percentages, if you didn't already know that, but you can designate 90% to children and 10% to charity, or however you feel comfortable doing that. And that's actually a very powerful gift. One, because it's sort of going to keep growing from the time you make the gift and the commitment until the time that your hospital receives it. But also, it's simple. You don't really even have to leave your home anymore to change your beneficiary designations on your IRA accounts to fit where you are in life, and where you're feeling financially committed when you're considering your legacy planning and your charity gifts. And so those are very powerful and very important, and we treat them in philanthropy just the same as gifts from wills and trust, because that's what they are, and they're going to be the future wills and trusts for the most part. So I'm going to ask Nick to speak a little bit about, not only is it easy to make your favorite hospital your beneficiary designee, but there's also some major tax advantages that you might want to consider if you have the choices between giving cash from your bank account in your estate or giving an IRA gift, and you're deciding which one to give to family and which ones to give to charity. There's some advantages there.
Thanks, Bradley. You're exactly correct. Generally, a spouse or a child or another individual is often designated as a beneficiary of an IRA, and when they receive a distribution on or after death, that's taxable. That's subject to federal and state income tax. So if a portion of that IRA, if a charity was designated as a beneficiary of that IRA, that portion that the charity received would not be subject to income tax. The charities are typically tax exempt organizations, so there's no tax paid on that distribution. So there can be substantial savings in tax paid on an individual's retirement in their IRA, and less going to our government. Right. Another benefit of it is after your death, distributions of your assets to a charity generally qualify as an exemption from your estate. So it's, an individual's estate is taxable as well. So there's also some savings there from strategies and estate planning to be able to maximize the benefit that remains in the estate. You can designate a charity as a beneficiary and therefore eliminate that estate tax as well.
I don't mean to put you on the spot, Nick, but could you remind us of the current estate tax exemption levels for federal and New York?
Yeah, so they're very high right now. So the estate exemption is they're about 5.5 million, 5.6 million per individual. So they're estate values aren't taxed until they're above that threshold. Anytime these thresholds are set, they're certainly not permanent. They can change anytime. So as easy as it was for our government to increase the threshold, they could reduce it as well. So 20 years ago it was $1 million exemption. So these estate planning opportunities could, even though, if your estate's not worth 5.5 million today, if they reduce the exemption in the future, which we all don't know that that's going to happen for sure, but it could, this planning still could make a difference. Yep.
Okay. And those estate exemptions don't apply to the IRAs, is that right? So that even if somebody, let's say, inherited $50,000 from an IRA, if they're a child of the deceased, they're going to pay taxes on it, right?
Absolutely. 100% of the time when an individual takes a distribution, it will be taxable. Yeah.
Great.
Can I add something to that conversation?
Please.
All right, so there were some tax laws, either in 2019, I believe it was, that when you inherit an IRA as a spouse, you can take it over your lifetime, right? That money essentially becomes yours and you can take it over your lifetime if you want to. And when we say that, we mean that there are required minimum distributions when you hit a certain age of 72 from an IRA. But now, if you inherit an IRA and you're a non-spouse, for the most part, there are some exceptions, you have to liquidate that account within 10 years. So say I'm leaving my retirement account to my children versus my husband, and they're probably just going into their high earning years at whenever I pass, they're going to be forced to take those distributions over a 10-year period. It doesn't have to be, it doesn't have to be every year over those 10 years, but within a 10-year period. And that could be impacting their taxes. And so it would be worthwhile for me to leave my retirement assets to a charity or a majority of them and leave my children other assets in order to kind of offset that, because I don't want to impact their tax situation, or if they pass, or if I pass now and they inherited it, impacting their college funding, in the FAFSA form and everything. So there are definite implications to and positives for leaving a retirement account to a charity or a charitable organization versus a non-spouse. Just want to add that. And then the other thing that we always talk to our clients about when it comes to IRAs is that those beneficiaries can be changed at any time. You're not locked in, and it's not difficult. I know with a will, sometimes you're hesitant to put a charity in there because there's a little bit of work involved in getting it changed. But with an IRA, it's purely a call to your advisor, and we can send you the form electronically. Like Bradley said, you don't even have to leave your home, and we can do it as often as needed. And that's true for any advisor out there. So if you want to change your mind, feel free. You can change those percentages at any time. However you want to do it, makes it very easy. I just want to add those points.
Those are excellent points. I'm glad you added them. And I'm glad you brought up the required distributions, because I was going to ask you to speak on that next, because they're back for 2021. And we want to make sure everyone knows that, if they're subject to required distributions, how that works, and how a charitable gift might help them out with the required distributions if they don't necessarily need the cash right now.
So so what I was talking about before is really how to leave a legacy, right? You're establishing something upon your death. But we also talk to people about how to give now or give over time. And that would include their required minimum distributions. And for people that are not familiar with that, that is something that it's an amount that you're required to take from a retirement account starting at the age of 72. Now, it used to be 70 and a half. And there's something called a qualified charitable distribution, QCD, that allows you to process, instead of getting the money in your pocket, so taking that money that the IRS is telling you have to take each year, instead of getting it in your pocket, you instead ask your advisor or broker dealer or whoever to send it directly to a 501c3 charity. And if they do that, you don't have to pay taxes on it. It does not, and again, leaving the tax information to Nick, but it is not taxable to you. And you're giving the charity a direct check, but you just aren't writing it. Now, the not taking receipt of the money is really important, because if you take the distribution and then write a check to the charity, you now have a taxable event. So it's a quick form. We just keep one on. What we do is a standing letter of authorization is how we formulate it, with whatever charities you want. And then somebody says, yep, I don't need that money this year. And so we say, no problem. And we have the account on file and we just send it directly to the charity. Makes it very easy. And a lot of places, not only hospitals, but churches and everything else, they receive that. And it's just as if you were writing right out of your checkbook. But major benefits. And you can start that at age 70 and a half, the old required minimum distribution age. You do not have to wait until 72. And it's up to, and Nick, maybe you can confirm this for me, I think it's up to $100,000 per year that you are allowed to do. So it's a significant amount, and you can do anywhere from $100 to $100,000. Very easy.
Thank you. Yeah, that is a powerful tool and one of my favorites in planned giving, to make sure everybody knows how that works. And if you don't know how it works, please reach out to your financial advisor and your tax accountants and check in with them, because they will certainly be happy to explain it and make that happen for you. Okay, so we're just about done with our talking points. I just wanted to highlight a couple of more thoughts before we turn it over to questions. One thing is that this year we developed in the Health Network a plan giving website, and we'll send out a link to that following this meeting. But on there, you can find tax ID numbers for your favorite hospital. You can find contact information. You can find in-depth information about the IRAs and the legacy gifts and all the things we've been talking about. If you just want to kind of sit and read that on your own time and soak it up, because it's a lot of information, but it's all there, and it's a resource for donors to learn and to prompt questions. So you can call Carrie and Elizabeth and Chantel and ask them or me, and follow up and see how this might work for you. And I want to leave you with these thoughts. I'm calling this sort of a donor game plan because we have so many donors thinking about legacy gifts and that don't share them with us, as I mentioned before. So there's some pitfalls if you go that route, and we want to avoid those. So if you're thinking about making a legacy gift, what I want you to do is also think about what you want to accomplish at the hospital with this gift, in terms of, if you're into adding things to buildings or equipment, or supporting patient care, or supporting the nurses with care gifts for them, or whatever it is that sparks your interest and your passion for giving. Think about that. And then I want you to call Carrie or Chantel or Elizabeth and talk to them, and make sure that there's a plan in place for what you want to do, especially in a hospital, because it's very tricky in a hospital. Equipment changes so quickly, things like that. So if you make a gift that's too narrow in its language, in your will, it may end up not being usable by your hospital. I know that sounds odd, but you know, I at the university once, we had an endowment for like typewriters, and that's all it could be used for. Well, you know, that was great in like 1970, but not so much now. And then your gift can't be used, and that's a bummer for everyone. So you talk to the philanthropy officers, and then they're going to send you to your panel of experts, your financial advisor, your attorney, your accountant, with some plans. And then that's where you're going to make your plans and your beneficiary designations and write the language into your will. And we can provide guidance for your attorneys for how to word those gifts in the wills. And then come back to Carrie and Elizabeth and Chantel and tell them that you did this and you've committed, and let them thank you and celebrate your gift, and include you sort of in the hospital family, where you should be. And then it's kind of a win-win for everybody. That's the game plan I would recommend. And I think that's all I've got. So we are really looking forward to questions, and I hope you've got some real tough ones for Nick and Christina.
I'm looking to see if anybody has their hand raised. I don't.
Can I ask a
Tom
quick
does.
question, and maybe I didn't
Okay.
understand?
Go ahead. Yep.
So you talked about the CARES Act, which was related to cash gifts. You talked about highly appreciated non-cash asset gifts. You talked about gifts from your IRAs. You did mention wills and trusts at the beginning, but then did we not discuss that at all? Is that separate from this conversation? I just wanted to get clarity on that.
I sort of glossed over it, Rowena. Sharp ears. I sort of glossed over it because, correct me if I'm wrong, Nick or Christina, but there's not like a huge like tax advantage or like tricky thing to do with wills and trusts, you know, that generally speaking, that because, you know, so those are kind of like legacy gifts, from the heart, and they're about commitment and stuff. And so so today I was kind of focusing on some of the weirder sort of trick plays that people don't know about that might give them some advantages. So I didn't get into that in too much depth, but we do have bequest language actually on the website that you could print off and take to an attorney and have them not necessarily copy it word for word. They could, but most attorneys won't, but they can use it as a basis, you know, to frame the way they're going to word your legacy gifts. And I'm always here, and Carrie and Elizabeth and Chantel are always there to answer those questions and even speak to your attorneys and advisors as well and answer their questions. But those gifts are hugely important to every hospital. So I don't want to minimize them by the fact that I sort of breezed right past it today.
Rowena, is there a specific question you had about your will or trust or anything like that?
Well, I think where I was thinking is I'm very methodical. So like, yeah, Bradley, I was like, okay, wait, you said that, but then we didn't talk about it. But also, so in some instances, I get that we wouldn't necessarily benefit as the giver, which of course, you know, it's great if we can do a win-win. But there are some instances where folks have wills and or trusts already, and it's not like I could convert it into, well, maybe I could convert it into an IRA. Could I? I mean, I don't know. And so if you're stuck with your will or trust, I was just thinking, you know, what, you know, how could that be used? And it just sounds like it's just a straightforward, you just leave it to the charitable organization that you want, and it's basically because that's what you want to do. But that's why I was asking, because I wasn't sure if there were things you could do with it to make it more of a win-win. I don't know if I could transfer some of that funding into an IRA. I don't know.
So a couple different things that we look at is we try to have direct beneficiaries named on as many assets as possible, first of all, so that it bypasses your will and doesn't have to go through probate. It just makes it easier for your heirs. And you can, like we said, you can name obviously direct beneficiaries of retirement accounts, but I don't know that as many people are aware that you can also name direct beneficiaries of after-tax investments, bank accounts, other assets, so that again, they bypass probate and probably cost you less in the end, right? So that's one thing that I would be looking at. As far as maybe converting assets to an IRA, so that gets a little bit harder the older you are, because IRA contributions are based on earned income, and so later in life you typically don't have earned income. So that might be more difficult, but you can still absolutely name a charitable organization in your will. I think that more and more people are looking at more complex things though, like a charitable remainder trust, because you mentioned trust. And so a lot of people are establishing those during their lifetime so that they get some income, and then the majority of the asset then transfers to the charity afterwards. But there are definitely multiple ways in order to make your will a little bit more inclusive. It sounds like you want to do with, you know, how you give to the charity. Many different ways you can do it. Estate planning attorneys, they're great.
And I would also add sort of the win-win angle on on gifts from wills that I always found is that they provide very ordinary people the chance to make major impacts in their giving. You know, and that's hard to do with a checkbook, but, you know, once your life is completed, you know, and your children are grown and school's paid for and stuff, you can leave a gift that can be really significant at that time from your estate. And, you know, that's sort of the win-win, is you get to be financially secure throughout your lifetime and your elder care and all that. And then when things are, when the money's not really needed, then, you know, then you can give it to the hospital and make that impact. And if you let us know during your lifetime, then we can celebrate you and enjoy that with you.
If somebody didn't want to name or let it inform CVPH or Elizabethtown or Alice Hyde as that they're going to be left as a beneficiary, could you have general language? Is there general language on that website that you were talking about? You know, just saying, you know, I bequeath this to CVPH, and maybe they wanted to go to a specific, like the Fitzpatrick Cancer Center, but do something, like, if that does not exist, then I just gift it to them to do with as they please. Because I do know some people like to be anonymous.
Absolutely. The language on the bequest language on the website is for a general use bequest. You could call or contact the hospitals, you know, and have your attorney run some more specific language by them. You know, if it was something very specific and you would just make sure it was right. And then, I mean, if you really want to, then you never have to contact them again. You know, just make sure that language gets into your estate documents, and whether or not the hospitals know about it or I know about it doesn't affect, you know, the gift reaching the hospital. So you can get that language and then remain anonymous, or work through your attorney as well. Your attorney, I get contacted by attorneys frequently who are working with anonymous clients, and you know, and I never learned the name, and that's okay. And I meant to mention this earlier, but I want to highlight the fact that even though all 3 of these hospitals and 4 in Vermont were all in the health network, all charity gifts designated to the specific hospital go to that hospital and stay with that hospital. So there's a lot of employees like me who are in the network who provide support services for all 7 of the hospitals and what they're doing. but the charitable gifts are all very separate and will be remaining so. So I just wanted to put that out there.
I believe Tom also has a question.
Just a quick question. Back to the state threshold exemption of 5.6 million. If am I correct? If you're fortunate enough to have an estate that's 10% maybe over that, you get hit with the cliff tax and then you don't get any exemption. So it may behoove you to try to get your estate under that exemption. So maybe by charitable contributions, you can do that. Are you aware of the cliff tax?
Yeah,
In New York?
that's correct. With the state, when you hit the threshold, it goes back to the first dollar value.
Zero exemption. So
Yep.
if you can get your estate, say you're 10% above that, you could donate and get yourself back into that
Yes,
exemption, so you don't lose it.
yes, very much so.
And that's part of, I think, what Christina was talking about a little while earlier, where you move as many of those assets away from the estate with designations and as well as charitable gifts prior to your decease to get those numbers down out of the estate.
Got a question for you, Tom, here. Probably for Christina. When we talked about what I'd call a bypass strategy for you specifically, we're talking about IRAs. I guess two-part question. Is it limited to IRAs or are broadly tax advantage retirement plans, 403Bs, that sort of thing? Are they eligible for that? Because I know required minimum distribution applies to those as well. And second part of that is the amount limited to the amount of the calculated required minimum distribution? Or is it that bypass strategy? Is that available for the distribution you may have already selected, the total?
Gotcha. So when you say bypass strategy, you were referring to the qualified charitable distribution, the QCD?
Correct.
Okay, perfect. And so as far as it's from a 401k, I believe so, or a 403b. I believe that is allowed, but Nick, can you give me a head shake to confirm? Yeah.
Yes, I agree with that as well. Yeah.
Okay. And then the amount is actually not limited to just your required minimum distribution. You have the ability to do anywhere from that $100. The $100 is just what our firm, our broker dealer, they don't want to process anything under $100, but so anywhere from that $100 to $100,000. It's not limited
To the calculated.
to the calculated amount.
Yeah. Thank you.
And that's an annual limitation. So it's 100,000 per year. Yeah.
That's huge.
Thanks, Nick. Thanks, Christina.
You're welcome.
Any other questions that anyone has? Let's see, I can read one that was sent in. Some of these we have already hit on. What legacy gift arrangements provide me with income during my lifetime?
That would, I would think that would probably be a qualified charitable remainder trust. You can put assets into a trust and essentially designate a charitable organization as a beneficiary of the trust upon your passing. But while you're alive, you can retain the income that those assets that you place in that trust.
Where are most folks setting up these qualified remainder trusts nowadays? I know, 15 or 20 years ago, they were often set up at the charities, but I feel like now they're more often set up maybe through banks or brokerage firms. I'm not totally certain. If you could highlight on that for me.
So I think that what we have found, and we don't have a lot of clients that utilize these, but what we found is that they often work with the charitable organization, and the charitable organization often has an agreement or a relationship already established somewhere that they work with them in order to get those, get the income started. So usually it's with an annuity, right? Annuities give you income. A lot of people are probably not utilizing them right now because interest rates are so low. And so the income that you would receive off of it would not be attractive. And so I think that depending on the markets and what we're seeing in there, I think, you know, we have ebbs and lows of when things are popular. So right now, charitable e-trusts or charitable remainder trusts are probably not the most popular items, but qualified charitable distributions seem to be where people are concentrating a lot at the moment.
Okay, thank you. Yeah, and I know we also have at CVPH, you can set up a charitable gift annuity, which is a little different than the remainder trust. Unfortunately, we haven't been able to expand that just yet to Elizabethtown or Hyde, but that program is in place at CVPH. And the interest rates on those annuities are actually based on actuarial tables and calculations by the American Council of Gift Annuities. So it's basically just based on your age, has nothing to do with your health status or lifestyle choices or anything like that. And that's guaranteed income for the rest of your life. And you can actually fund those with appreciated stocks as well, and achieve a few tax advantages through that and create income with a stock that's highly appreciated and you don't want to sell it because of the taxes. And you can convert that into income through the gift annuity program.
We did have a donor who set one of those charitable gift annuities up, and she lived to be 101. So I'm pretty sure it's because she had an annuity set. She got a really great rate because she set it up when she was 95. Another question that we have is, what is the advantage of naming my hospital as the beneficiary of my IRA, a bank or brokerage account? And is that approach better than a request in my will? And we've talked about some of the advantages already, but weighing the two, is one approach better than the other?
Well, I think it kind of goes back to removing assets, you know, the taxability of the estate, and giving rather, it would be preferable to give people assets that are after tax versus taxable. And it just saves on both ends if you're naming an organization as a charity. And again, very easy to do. From my perspective, the tax perspective, I'll leave to Nick.
No, you're completely correct. You know that you know, if you've got after tax investments that go through your estate, you know, your beneficiaries of your estate get a stepped up basis. So so that built-in gain sort of disappears as that appreciated asset flows through the estate. Where if you name an IRA, a charitable organization as a beneficiary of an IRA, that does save the tax, because a distribution out of an IRA to an individual is taxable 100% of the time in the entire distribution, and taxes ordinary income.
Thank you. Any other questions that anyone might have? The other questions that were submitted, we've all have already covered so expertly, so thank you. Well, then I think with that, we will actually commit to keep on time as promised and at our 1 o'clock time frame. I certainly want to thank you so much, all of you, for joining us this afternoon, for your continued commitment to investing in healthcare in New York. We will be sending out a survey link. Drew is going to send that out for us. So we'd love to have your feedback about the event today, and sharing any other interests that you may have in learning more information. And as Bradley had mentioned, we do have a Plan Giving website, so we'll include that link in the email as well. And you can check that out and certainly reach out to Chantal, Elizabeth, or myself if you have any questions. So thank you so much for our panelists, to Ellie, to all of you for joining us. It's great to have you. Great to see you.
Thank you.
Thank
Take
you.
care.
Thank you. Have a great day.
Bye.
Thanks, everyone.